Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Getting Started with Options. And today's discussion is going to be all about avoiding the pitfalls that we can commonly stumble into. We're going to be talking about 5 trading errors that beginners often make when they're trading options. We're going to talk about how they might also be avoided. We're going to be going right from the conception of a trade all the way to the end, finding the mistakes all the way along the line. It should be a great discussion. Before we get to any of that, though, let me first of all say hello to everybody who's already chatting in out there in YouTube. Hello there, Sharon, 35 Wealth, Paul, Will, Josh, who else is here? Eva, everybody else. Thanks for joining us week after week. There's Roger. Hello, Roger. But thanks for joining us. We always appreciate your attendance and your contributions to these discussions. If you're here for the very first time, and there were a couple of names in there that weren't entirely familiar to me, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, we'll enjoy the presentation, but be aware that you're invited to join us in this live discussion. If you'd like to be here, this is a Tuesday webcast series, and we kick things off right at noon Eastern. We'd love to have you in the live stream audience. And as a treat for my live stream audience members right now, my very good friend Connie Hill is going to be hanging out in the chats with us. Connie's going to be addressing any questions that I can't get to just during the flow of the presentation. Thanks for having my back there, Connie. And Connie and I would also like to issue an invitation to everybody listening. If you have an account on X, you should be following your favorite presenters there. That's really the very best place to connect with your favorite presenters in between these live streams. Matter of fact, I was on X this morning. I probably replied to about 20 different back and forth posts there with my followers. So yeah, very best place to connect with me. You can find Connie at Connie Hill CS, me at Cameron May CS. But let's go right to the discussion. And of course, as we do, we need to consider the risks associated with trading and investing. Risks are real. They certainly apply to the strategies that we're going to be discussing today. So bear these important disclosures in mind. And as we talk through this, of course, also what I'd like you to do as we're going through these 5 mistakes that beginners often make, just check to see if there's 1 or 2 or 3 or 5 of these that you, if you've already been trading options, have made yourself. Is this stuff that you would suggest maybe new beginners look out for? Anyway, options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as sole means of investment research, and investing involves risk, including loss of principal. Tom says you're a first-timer here, excited to be attending. I'm excited to have you here, Tom. I always like having the new faces in the crowd. I hope that you can fit it in your schedule if you're new to this. It's great if you can be here during the live presentation. Also be aware that these sessions are recorded and posted to our YouTube channel. So if you haven't subscribed to our YouTube channel just yet, click on that subscribe button now. It doesn't cost anything. It only takes a second, but that's where we post our archives of our completed webcasts. All right, but let's talk about what we're going to talk about. Got 45 minutes to spend together today as a maximum. We're going to be talking through top 5. These are my top 5 mistakes that beginners make when they're trading options, but I also want to talk about how to avoid these mistakes. So really, the way that I see it is there's a journey all the way from the conceptualization of a trade to the execution and the end of a trade. And along the way, we're going to take a look at 5 different phases of the trade and see a common mistake for each that traders might make along the way. I'm trying to make this journey a little less bumpy. Certainly, there are going to still be risks at the end of the day, but it doesn't always, we don't necessarily have to expose ourselves to risks if it's not necessary to do that. So let's get into this. And the very first thing that I wanted to talk about that can be a real hang up for some traders just trying to get started, and actually a lot of veterans can be prone to this one as well, is that thinking that in planning the trade, if we're using charts to plan the trade, that more indicators on the charts equals a better trade. Let me just go right to our first example here today. Here's Amazon. Will, you say this is going to be great? I think it's going to be a good discussion here, Will. And let me know if anybody out there sort of fallen victim to these sorts of thought processes or these sorts of errors before. So now when I say that a trader uses lots of technical indicators. Is that always an error? No, it's not necessarily an error. There could be a perfectly valid system that's created using a whole bunch of different indicators on a chart. But what could be a problem for someone who's just getting their feet wet with trading, but they're getting excited about all the potential of all these different technical tools that they've learned about? Number of problems. Number one, let's talk about the motivation of using lots of technical indicators. I think that it makes sense that a trader is starting off the planning of a trade and they think, well, maybe this trade works out, maybe it doesn't. I don't know, maybe it's a 50-50 proposition just to start off. And what I'm hoping to do is to increase the odds of success using indicators on a chart. So if one is good, potentially, maybe two are better, and three is better than that, four is better than that, maybe I'm moving my probabilities of success. Of course, success can also be related to the individual strategy selected. But the trader's ultimate objective is to eliminate risk, feel really confident about a trade, and then go ahead and place that trade. In reality, let's talk about reality. Does adding layer after layer after layer of technical sophistication mean that we're moving that needle invariably toward 100% confidence in the success of that trade? No, it doesn't. It's conceptually possible that we might be moving that needle somewhat, but there may be some diminishing returns there. We could go through all of this work and the trade could still fail. So that's one thing. It may be unnecessarily complicated. Second potential issue with using lots and lots of technical indicators is that if we are convinced that we have moved that needle firmly, it can lead to overconfidence in a position. This is the one I've been waiting for. This is the trade that can't fail. And as soon as we start thinking that trades can't fail, that can lead to potential trade mismanagement. All right, a third problem. And I think some of you probably anticipated this. When we have lots and lots of technical indicators, we're just saying, okay, all I need to do to get this trade working is to have all of these stars in alignment. I need the entire firmament in a perfect row, and that's when I'm going to place my trade. And guess what? We probably never get there. Instead, we wind up with what we call analysis paralysis, waiting for the perfect scenario, thinking that that's going to deliver this extremely high probability of success, or patiently waiting for it, and that day never arrives. So it might cause the trade to never get off the ground. Maybe a lot of perfectly legitimate trades go right past us and it never happens. But then finally, if that trade does come around, let's say we finally get all those stars in alignment, there it is, the magical constellation of trade signals. Well, now the trader may be very reluctant to get out of what they waited so long to get into, and it can actually lead to hesitation on exits when otherwise it might have been prudent to get out. Also, if a trade was this hard to get into, when we had a whole bunch of different stocks that we might consider trading, now we have that one position. If we're waiting for a similar constellation of factors to get us back out, we just may never see an exit signal. It might be a very confusing exit. So what's the bottom line here? How might a trader avoid this first mistake? I might just clean that chart up. So I'm going to come up here to where it says studies. And yeah, we have lots of maybe fan favorites out there. It depends from trader to trader. Yeah, I have a moving average. I actually have a Bollinger Band. We have a ribbon study applied. We have a parabolic stop and reverse. We have a couple of linear regression channels applied, MACD, CCI, RSI, Chaikin money flow. Shouldn't these all add up to a great trading system? Cameron, haven't you discussed every single one of these in previous webcasts before? I have. Doesn't mean every trader should be using every single thing that I'm talking about. These are educational discussions. Anyway, let's go up here and I'm going to remove all of these studies. And I want to throw out a question here. As we're looking at this now, much cleaner chart. Is it possible that a trader might just take a look at a trade? Could a trade be built even without the assistance of any technical indicators? Let me load this up. Here's just a couple of drawings that I made this morning. And what some traders will do, and there can be very veteran traders, pardon me, let me mute myself. There can be some very veteran traders that don't use any indicators at all. Instead, they may just observe price movement on a chart and start to build their option trade around that. For example, here's Amazon, and a trader might look back in recent history and note, hey, it looks like this stock ran up from about $200 up to about 218, and then it pulled back. Came down to about 207, and then it went up to about 225. Those are proportionally pretty similar moves in very recent history. And then we've gotten a recent consolidation. Again, the stock seems to be on the move again. Yes, they might see, oh, it looks like there might be a bit of a bull flag there. But in any case, maybe now that it's gotten up ahead of steam, could it go up another $17 or $18? And they may plan a trade just around that visual evidence. Could there be validity to just that sort of approach? There certainly could. Is it guaranteed to work? Nope, but neither is a highly sophisticated approach. Some others might decide to include, as they're getting comfortable with technical charts, to add maybe one layer, maybe a second layer, another indicator or two. So, for example, maybe a trader, let's go up here to our study set. I'm going to load up a study set using a MACD oscillator and a moving average. So in this case, I just have a combination of a 20-period simple moving average, possible trend indicator. Just if we're about to place, let's say, a bullish trade, maybe trader prefers some mechanical confirmation of apparent bullishness. And then maybe they want to see that momentum seems to be moving in the right direction in the short term. So as an example, in this approach, maybe the trader has done their own price analysis first, and then they might just look to confirm with upward trend. And let's say that our MACD histogram, possibly their confirmation that it's time to get into a trade, is when the MACD is rising up, when we see these bright green histogram bars rising, getting taller. There have been examples of this in the past. Here we have an upward sloping trend line, and then we see our histogram bars starting to rise into the bright green. So there may have been a signal for bullishness there, might have been a signal for bullishness there. It doesn't always work out. There's been a recent one about here that didn't work out terribly well. But yeah, it could be that a simpler approach might be a better one in some cases. Again, this is not to suggest that any technical approach is inherently superior to another, but sometimes it doesn't need to be that complicated. All right, so that is example one, and that's before the trade has even started. So let's move on to example two, which comes when a trader is selecting the specific option to trade. So let's put ourselves in the shoes of this trader who thinks, all right, well, it looks like Amazon's on the move. Let's go place an option trade on this. Maybe it's in an upward trend, seems to be just starting into a new move. Our oscillator seems to be confirming. We have a relatively clear picture of what the trader has in mind here. Now it's time to select the trade. And the next mistake is when the trader doesn't match the trade time frame to the expected time frame of their trade move. So a couple of errors that can be made here. One is to enter into a trade that's too short in time. Another is possibly to enter into a trade that's too long in time. So let's just do some quick analysis here. Let's say that our trade, and again, we don't know exactly what's going to happen, but we think that this has a new head of steam. And the assumption here for our trader is maybe this will move up as far as it did before, and possibly at about the same pace. So previously, looks like this move took a little bit more than a week, maybe a week and a half. This one took about a week. So let's say that our trader is thinking it might take a couple of weeks. One mistake, if they haven't assessed that with options, time in the trade can be vital. Not just timing the trade, but time in the trade can be vital. So if, for example, the trader goes to their trade tab let's say that for Amazon, and I'll just keep this as straightforward as I can. Let's not get into more of the more multi-layered option strategies. I'm not going to do multi-legged strategies today. Let's just buy a call for today's example. Well, there are actually calls available that only go out for 3 days. Why might a trader be attracted to those sorts of options? Well, if we're buying an option, the more days we buy, the more expensive the trade becomes. So the trader might come to this and say, well, a call option is bullish. I'm bullish on this stock. So let's just spend as little money as possible, maybe stick with a 3-day contract. Well, but then if the trade takes time to make the move that we anticipate, we run out of time, we've left potential on the table there. So that's one mistake, but it could also be a mistake to buy more. Yeah, Paul says theta can burn, right? Yeah, when we only have 3 days to make a move, we get impatient really quickly, and there's actually mathematical consequence to that, risk consequence to that. 3 days to make a move. If that stock doesn't make the move very quickly, the time decay element of the option can really chip away at that investment value. And even if it starts to make a move, if it's not big enough and not fast enough, it could still be unprofitable. All right, now, what about buying quote unquote too much time? Maybe our trader thinks it's going to take a couple of weeks, but they want to give the trade time to breathe. So let's say they go out and they buy a 3-month contract, 94 days. That would be about 80 days beyond the expected trade time frame. Well, if I go and look at that, let's do a quick comparison just so that we can see the point that I'm making here. If let's see, our stock is trading around $227. So our strike price that's closest to that is the 227.5. That's our at the money strike. For the 3-day contract, it's about $2. For the 94-day contract, I don't even know if there's going to have nope, it doesn't. We're going to have to compare the 225. Not every expiration has exactly the same sequence of strikes. So let's get one where we can do an apples to apples comparison here. So let's look at the 225. It's only less than $2 below the current price. About $3.30-ish to buy that contract. Well, if I go out to 94 days because the trader's interested in making sure they have enough time, well, 225, that could cost about $15.50. 5 times as much money to be spent here. The cost of the trade can go up significantly. Now that's one potential error, but another potential error is this can lead the trader, it can leave the luxury of making excuses for an uncooperative trade. You know what I'm talking about here? How many of you more veteran traders can relate to this? How many of you have had the thought, don't admit to anything you don't want to admit to, but you buy a call because you think the stock is going to go up, and then the stock doesn't start to go up. It waits a day or 2 or 3, it waffles around, it's going sideways, and you say, that's okay. My premise isn't working out, but I still have time. Time is not a luxury with options trading. It's the enemy of the buyer of this option. Don't start treating it like it's a friend. It's actually chipping away. So if we say, that's okay, I still have time, we're sort of linking hands with the enemy. If you can relate to that. Making excuses for a trade where our premise is already crumbling. Sometimes we're wrong. Buying too much time can kind of obscure the fact that the trader has just not picked the right time. And maybe now, is it possible the stock could start to cooperate suddenly and it starts going up? Of course it is. But yeah, beginning with that end in mind and adhering to a strict time frame and understanding risk and having it justified by performance, that can potentially add discipline to this enterprise that we're attempting to undertake. Okay, so how might a trader avoid these sorts of mistakes? Really, now we're talking about buying a call, and I'm going to use that as our example trade, but the selected time frame can vary depending on the option strategy. I can't cover every strategy in every time frame, but generally speaking, when buying a long option, a common rule of thumb is to figure out how long we think the trade is going to take. This one looks like it might take about 2 weeks, but then we double that time frame and make sure we buy at least that much, maybe a little bit more on our contract. That is not to give an excuse to a trade that's not working, but what it can also do is it keeps us away from expiration. We already talked about time decay. The closer the trade gets to expiration when we own a call or a put option, the faster that time decay can kick in. So the balance we're trying to strike here is making sure that we have enough time for our trade time frame, but giving us additional time so we can get out before the hardcore time decay kicks in. Okay, Paul says, I prefer triple the expected time. And Paul, if the trader is comfortable with the trade-off there, the benefit here being maybe a little additional flexibility with timing, maybe we can stick with the trade a little bit longer, but also having a plan maybe to get out before the time decay kicks in. What's the trade-off? It's certainly going to be a little bit more expensive to do those trades. So that trader just needs to weigh the pros and the cons, make their own decision. All right, so let's say that our trader has looked and they've determined that we need at least, let's say, 4 weeks, 28 days. It looks like the 18th of August will get that accomplished pretty neatly. So let's go to the 15th of August. I say 18th, 15th anyway. 15th of August, and now let's buy an option. How about for this one, for the example, since we were talking about the 225, I'm going to trade that 225 strike. Now, there are lots of questions that be left unanswered on this table here. Cameron, how did you choose the strike price, for example? I've actually dedicated an entire webcast to just that topic. So make sure that you're checking out our library of previous webcasts if you're trying to refine your understanding of different approaches to the markets. So if you haven't subscribed, make sure you subscribe to the channel here. And then you can go to the playlists on our Trader Talk Schwab Coaching webcast channel on YouTube. And this is where you can find the playlist for our previous webcast. For example, Getting Started with Options is going to be down toward the bottom of all of our playlists. I have lots of these things. There's Getting Started with Options. I can click on that View Full Playlist, and I can look down through all of these previous webcasts. And on a couple of occasions, we've just talked about just strike selection. All right, but back to our trade. Here's mistake number 3. And this one actually is not a great example of this mistake. So I want to bring up a different stock. Let's say that we had decided that we were going to buy an at-the-money call, but on a different stock. And I want someone out there, see if you can spot the mistake before I say it. All right. And as you do that, I'm going to call something to your attention in the chats. So here's TDY. It's Teledyne Technologies. Let's say our trader was planning on buying an at-the-money call for this one. See if you can see something in this options chain that might cause some traders to go, hold on a second. There's something else to consider here before placing this trade. Anyway, so as you're thinking that through, I do want to point out that there's been a survey link that's been added to our chat window. It says survey time. Yeah, we don't always get the opportunity to give feedback to your presenters in the form of these surveys. So when you see that, do us all a favor, click on the survey link. That'll bring it up. You can fill it out if the webcast is over. But fill out those surveys when you get the chance. They're really short, 2 multiple choice questions, a comments box and a suggestion box. But I always promise you, if you take the time to fill out those surveys, I'll take the time to read through the surveys. I read through the data, I read through the comments, and it helps me prepare for future webcasts. All right. This is interesting. Yeah. Vic, Sia, Jay Richardson, Irma, Eric, Simon, they're all saying, look at the spread between the bid price and the ask price here. Here's what they're talking about. See these 2 columns here? They're on the option chain all the time. You can't take them off. So bid price is typically at or around where an options trader will sell their contracts. The ask price is at or around what the options trader will pay for their contracts. If there's a big difference between those two, To some traders, that's a big red flag that this is an illiquid contract. Not very many people trading it, and it's caused that spread to widen. And that can really make it difficult in a number of ways. It can be a legitimate error in trading because it can lead to it's harder to enter the contract. It can be harder to exit the contract. And in both scenarios, we may not be thrilled with the prices received. Here's the example that I would make right here. Let's say that our trader went ahead and decided to buy this call and they just paid the ask price. Hey, other trader, how much you asking for a contract? 18 bucks? Great, you pay it. Now we get immediate buyer's remorse. Paid $18 per share. That's $1,800 for the right to buy Teledyne Technologies for $540 anytime in the next 31 days. That's what that would equate to. So we just paid $1,800 for this trade. And let's say we get immediate buyer's remorse. What have I done? I'm going to sell this thing. Okay, what will somebody bid me to get me out of this contract? And we sell at the bid price. How much would we sell that for? Without, no time has gone by, so there's no time decay. Volatility levels haven't changed. The price hasn't really significantly changed on Teledyne. It's still within a few pennies of where it was when we started discussing it. And yet we sell that call that we just bought for $1,800. If we sell it at the bid price, we sell it for $1,200. That's a $600 loss. 33% of our investment is poof, gone in an instant, having made no other error than to ignore the bid-ask spread. That's it. Can you see how big of a mistake that might be? That is a huge mistake that some traders will make. Now, there are some that are going to go, I don't care. I'm going to buy this thing because I'm so convinced that this is going in my intended direction that it's worth it to me. Okay, that's up to the individual trader. But yeah, Paul says once is enough to learn that mistake. Yeah, if we place the order and if I were to place this order and I go look at my profit or loss right now, it would say, hey, Cameron, you're $600 underwater. What? Yep. This trade started off in a deep hole. So how do we avoid that? We pay attention to it. Let's go back and do that same logical walkthrough on our Amazon trade. Still an at the money strike. So I think it's a fair, same expiration. I think this is a relatively good apples to apples comparison. There's always a difference between these two. But you'll notice this is much narrower. If I bought this call, got immediate buyer's remorse, I spent $1,050 and sold it. Let's say I'm able to sell it at the bid price. I'd be selling at $1,040. That would be a $10 hit on a $1,050 investment. It would be, what is that, 1%? It kind of stings, but I'd probably just move on with the day. Yeah, that's not a devastating oversight. And now it's actually 5 cents. So what some traders will do, as a general rule of thumb, not everybody looks at it this way. Different traders are going to have their own different personal rules. They may just look at, okay, what is my ask price? And I may not want to see that bid price be more than 10% less than that. I know 10% sounds like a lot because it is. But yeah, for some traders, they set a maximum threshold there. Maybe it's 5%. Maybe it's 10 cents. Maybe it's, some other thing. But at least having a personal rule to draw awareness to the fact that the bid-ask spread exists can help us to sidestep that kind of an error. So I'm going to go ahead and place this trade. Right? Let's just buy one contract. Buying the 225 Amazon call. Let's click on that. Buying that one contract. Let's say that we're willing to spend. This is just in the interest of trying to get a relatively quick fill so we can continue with our discussion. I'm going to put a limit of $10.50 on this. Still a chance the order might not fill. Matter of fact, that's a natural. Let's hurry up and submit this. Buying this 15th of August, 225 call for $10.50. There's a commission to be paid on this, as there would be on the other trade scenarios we've discussed. Let's send that order off. And we just bought that. Okay, we bought it for $10.45. So our trader now goes to, let's go to it's going to be down here in our unallocated field. Let's close up our other webcast things. So here's our Amazon position. We own the one contract. It has 31 days left on it. Bought it for $10.45. That's what it's worth right now. And let's just say that our trader sees this happen. We thought the stock was going to go up sharply, which should benefit a long call position. But instead, we get, let's activate this drawing. Let's say we get this kind of a move. In the 2 weeks, we expected the stock to move up maybe $17, $18. Maybe it only moves up a few bucks. It's gone from $227 up to maybe $230. So a $3 rise in our price, and understanding what we do about call options, we think, good, all right, I should have a nice little profit here. And I go back and look at the monitor tab, and I look in my profit or loss field. And even though the stock has gone up $3, and again, hasn't, we're just playing pretend here for just a moment. Maybe I look in this PL Open and I see a very nominal profit, maybe even a loss. This is where I've literally had contact before. I've been talking with traders who are just learning about options. They say, Cameron, your delta is broken. I looked at this trade. I expected when a stock goes up, a call is supposed to make money. My stock went up and my call didn't make any money. This is a rigged game. It's fixed. I'm out of here. That's a mistake. So we've made mistakes before the trade. We've made mistakes selecting the trade. We've made mistakes placing the order. Now there's a mistake in interpreting how this investment can change over time during the duration of the investment. And the mistake here is thinking that price is the only thing to keep an eye on our way toward exiting the trade. Price can certainly contribute, but what are the other two major variables? Trader has to understand this to really know how options trades truly work. There's price, there's also the passage of time, and there is volatility considerations. So yeah, when we buy a call, that gives us, in this case, if we buy the 225 call, we have the right to buy shares at $225. Okay. Well, let's include that right with the passage of time and see how ugly it can get if we don't really understand how options really work. Let's say that we buy this right to buy shares for $225 and the shares do go to $230. Okay, we have the right to buy these shares for $225. They're worth $230. Awesome. That's a $5 value. And let's say that we get all the way to expiration, 31 days from now, and it comes time to, we're making our final decision. Do we exercise the contract or not? And we probably decide, yes, we're going to exercise this contract because I'm now buying shares that are worth $230 for $225. That's a $5 profit, except I forgot the fact that it cost me $10 to set this trade up. It was actually $10.45. If I make $5 on a stock, but I spent $10.45 plus commissions to set that trade up, by my math, that's a $5.45 loss per share. And that trader, having called the direction on the price correctly, just lost $545. That's because of the time decay. We lost the 31 days of potential in that contract. That's gone. So that's a consideration, but that even can be accelerated. We don't even have to get all the way to expiration. We might actually lose that time value of the contract if nobody else is interested in these contracts. Volatility can lead to demand or lack of demand for options. So right now, to buy this contract is about $10.50. There are actually different circumstances where it might have cost us less or more to buy with the same 31-day contract. Maybe a month from now, if we're buying a 31-day contract on Amazon, it might cost $8. Maybe 6 months from now, if we're buying a 31-day contract on Amazon, it might cost us $15. And that has to do with how much volatility traders expect during the time frame of the contract. When we're buying and a lot of volatility is expected, the contracts are more expensive. When we're buying and very little volatility is expected, the contracts are less expensive. There's just not as much demand for them. So price and time and volatility can all play a role, and not understanding that is what leads beginning options traders to make the mistake that that there's a scam at play here. Well, price went up, my call lost money. That should never happen. Yes, it can happen. So how do we really understand that? How do we avoid that mistake? I'm going to help you with that. I have a video that's called The Vital Role of Options Pricing and the Greeks. So the Greeks, specifically Delta, Theta, and Vega, can help the trader understand the potential impact of price, time, and volatility on their investment. And so I'm going to put that link here. Let me just copy this. I'm going to paste it into the chats here. There we go. That's my video titled The Vital Role of Options Pricing. Really understanding what ultimately drives the success or failure, truly understanding what ultimately decides the success or failure of an options contract. So if you didn't understand the last 3 minutes of this discussion, you really need to watch that video. And if you don't happen to be here in the live audience, let me show you where to find that. Here's what you would do. Again, make sure you subscribe to our Trader Talks channel, but go to the channel homepage on YouTube, Trader Talks Schwab Coaching Webcasts, and then just do a search. Type in Greeks. When you do that, you're going to see a number of webcasts, but really just about the fourth one down. Lesson 5 of 10. I actually have a whole beginners series, a very in-depth introduction to trading options. So it obviously would start with lesson 1. Well, lesson 5 is the vital role of options pricing and the Greeks. All right, there we go. So it's okay to talk about making mistakes. It's more helpful to learn how to potentially avoid them. Now, let's talk about the end of the trade. Mistakes can be made all along the way. And a common mistake, fortunately, it's not terribly common, but it can be spooky when this happens. At the end of the trade, letting an option expire in the money can be an enormous mistake. What does that mean? Well, let's go back to our trade. We bought a contract that gives us the right to buy shares for $225. Here's how I hear this described all the time, and it's accurate, largely accurate. Paul, that was another one. Paul's already thinking of other mistakes that traders might make. You think they're really only 5? No, there are lots of mistakes that could be made. So I just compiled what I considered to be some common ones that are made at each step along the way. But there could certainly be other mistakes that are made, no doubt. But in this case, we have the right, the theoretical right to buy shares. I've got to say theoretical. It's actually is a paper trade. We're just doing paper trading here. But we have the right through the 15th of August to buy 100 shares of Amazon at any time for $225. But I commonly hear that described as the right, but not the obligation. That's an accurate statement for a period of time. But what happens at expiration? Actually, that right is no longer a right. If we haven't done anything with this contract, and if the price is above our strike price, our right then is transmogrify a real word? Why did that just pop into my head? Anyway, it changes into an obligation. What happens with every single in the money contract where there is not a standing do not exercise order in place? They're exercised. Yep. Now, back in the day, when I first started trading, contracts that were in the money that weren't just manually exercised by the owner, they would just expire worthless, even if they had a ton of value. And new traders didn't realize that. It was an expensive mistake. And so the rules were changed where brokerage firms are now required to exercise any in the money contracts. So let me explain what that means here. Let's say that our stock does what we thought it was going to do. let's say it goes up, maybe it goes to 230, maybe it goes to 240, it's up here against this resistance, whatever, but we hit expiration. So this contract expires out here on the 15th of August. Let's say it's up there. Let's just use 240 as our example. Shares are up at 240. We have the right to buy those shares for 225. That is a $15 value. So that contract is exercised automatically. We buy the shares for 225. Well, we're getting a discount of $15. So that actually at the moment is the right thing to have happen. But we also got to acknowledge that's a $22,500 expense to the portfolio. That's a consideration. Also, what could happen on Monday? Now that we're the proud owners of 100 shares of Amazon, we bought them for 225. They're worth 240. That's awesome. But on Monday, what if the price starts to slip? What if the price collapses? We are owners of shares and we have the exposure to share ownership all the way on down to zero. That completely changes the risk reward scenario of the trade as it originally stood when we thought we were just investing $1,000. So letting options expire in the money is a mistake that some traders make when it's easy to just sort of buy this and think, you know what, forget it. I'm just not going to work. I'm going to let it just expire. If it goes into money, it doesn't just expire. It gets exercised. So what might the trader do? Well, they could actually just enter an order that if they happen to forget about it, let's right click on this position. Let's create a closing order to sell this contract under the condition that it's gotten closer to expiration. Maybe we could set it for the day of expiration, maybe a few days before. Maybe it's just at the end of the 2-week time frame that we were planning for. How about we do that? Let's submit this order to sell in 2 weeks. So let's put this out there July 29th, sometime during the day. This is local time, 1041 works for me. That's fine. We can be that specific. But we're just saying, hey, on July 29th, at whatever time we designate, we want this to happen, whatever this is. In this case, we want to sell that one contract. We don't know how much it might be priced for at that time. Let's just make that an order to sell. Okay, so let's save. So what I'm specifically doing here, well, actually, you have to set this as a day order. Anyway, I'm creating an order to sell this contract. Now we still have to remember that we placed this order. So if we decide to sell before then, we want to cancel this order. So I'm not actually going to put that one in, but I wanted to show how a trader might avoid letting a contract get all the way to expiration, having it exercised when they didn't intend to, winding up spending a lot more money than they intended to. But guys, we've talked through 5 mistakes, my top 5 mistakes that beginners make when they're trading options. We've talked through how they might be avoided, how there's a mistake pretty much at every step along the way. So I hope you enjoyed this discussion. I thought it was a little bit of a departure from my typical routine here on Tuesdays. So I want to invite you to join me again, though. Next week, we're going to be doing, again, a deeper dive into getting started with options. Well, you thought that was valuable? Excellent. Tatiana says, will theta play a role? It certainly could. That's why we don't know the market value at that time, Tatiana, and why the trader might choose to put in a market order as opposed to a limit order, which might be just the wrong price at that time, might not fill. Okay. Anyway, everybody, I'm going to let you go. Enjoy the rest of our webcast for today. I'll be back again next Tuesday for this series, but I have something new every single day of the week, and you're certainly invited to join me in my other webcasts. Also, would like to invite you to follow Connie and me on X. You can find Connie there at Connie Hill CS. You can find me on X at Cameron May CS. But yeah, as I mentioned, this is the best place to connect with me in between the live streams. And you can we can sort of have an interaction. Like I posted today about CPI report that came in, seemed to be initially disappointing to traders. We'll see if that continues. I asked yesterday, how did you think the CPI report's going to go? And I spent this morning replying to a lot of these posts that came in response to my posts. I like that little interaction that can be had there. Connie, thanks for helping out in chats. Everybody, there is a survey. So go ahead and click on that survey link now if you haven't already done so. Time to fill out that survey. Give me some honest feedback. I'll always read through that data. I read through your comments, and it's always helpful. And thank you for 181 people watching. I can see that 70 people have already clicked that thumbs up. That's awesome. Thank you for doing that. If you've enjoyed a webcast, make sure you click the thumbs up. Make sure you like that webcast. It's a pat on the back to the presenter for a job well done. It also promotes that presenter's webcast in the YouTube algorithm, helps them find a larger audience, helps people learn about these sorts of mistakes that traders can make, and maybe help them avoid them as well. All right, everybody, I'll see you in a future webcast. I will also look for our next, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.